In certain cases, we have to prepare a profit and loss account also. That is called a shareholders account or non-technical account. When you prepare the profit and loss account, balance from the revenue account, that is carried forward to policyholders account. Here, let us see how to. We can start with that Sun Life Assurance Company. How to prepare a profit and loss account, that I will show you. From the examination point of view, revenue account is important. Then at least you should know how to prepare a profit and loss account. Yes. This is also Form A P&L account, profit and loss account. Form A P&L. Sun Life Assurance Company, Sun Life Assurance Limited. Sun Life Assurance Limited. Profit and loss account for the year ended. For the year ended. (31/3/2018). This is called a policyholders account. I'm sorry, by shareholders account. Non-technical. Shareholders account, non-technical. First item, the balance carried forward from revenue account is given, that is 3,000. Surplus brought forward from revenue account. Surplus brought forward from revenue account, that is given 3,000. Below that you have to see income from investments. Same as in the case of revenue account, income from investments. Income from investments. Income from investments. Below that you write, first one is interest, dividend and rent. Interest, dividend and rent grows. Then profit on sale by redemption, loss on sale by redemption, other income. The same items which appear in the revenue account, they will come. Interest, dividend and rent grows. How much is interest, dividend and rent grows? It may be given. Interest on general investments 200. Here no schedule is to be prepared. Interest on general investments 200. Profit on sale by redemption of investments nil. Profit on sale by redemption of investments nil. Then loss on sale by redemption of investments, that is not given. Other income, whether there is any other income to be included. There is transfer fees. There is other income. Now we have to deal with the other incomes. Income from investments, then other income. Other income, you have to specify the income. First, transfer fees. Transfer fees. Then comes miscellaneous income. Miscellaneous income. How much? 6. Miscellaneous income, not 6, but it is 15. It is 15. Miscellaneous income 15. Miscellaneous income. So much about the incomes. So, first item that appears is balance that has been transferred from surplus that has been brought forward from revenue account, then interest, dividend and rent that is returned. Here there is no profit on sale bar redemption of investment, loss on sale of investments nil. Then other incomes. Other income you have to specify which are the other incomes. Transfer fees 10, miscellaneous income. Now you will get the total A. Total A. Total A is 3,225. Now we have to write expenses other than directly related to insurance business. Expenses other than directly related to insurance business. Expenses other than directly related to insurance business. Let us see which are the expenses other than directly related to insurance business. One is general administration expenses, then loss on revaluation of general investments, yes. But general expenses other than directly related to insurance business, you write loss on revaluation of general administration expenses, general administration expenses, general administration expenses 15. Then comes loss on revaluation of general investments, loss on revaluation, loss on revaluation of general investments 20. Then is there any bad debts written off? Bad debts written off nil. Provisions for tax other than tax, provisions other than taxation nil. Then others, other expenses, others. Under others comes directors fees, then comes donations paid, donations and directors fees. Directors fees 6, donation 4. Others, director's fees 6, donations 4. Now you are getting total B. Total B. Total B. Total B is 45. Total B 45. Now, total B you got 45. Next is profit before tax. Profit before tax, you write profit before tax. A minus B. Profit before tax is how much? A minus B. 3,225 minus 45, that is 3,000. That is 3,180. 3,180. Now you have to provide provision for tax. How much is provision for tax? Taxation provision. Provision for tax is 50% of profit. So 50% of 3,180, that is 1,590. 1,590. Then profit after tax. Profit after tax. $1,590. With this, last year profit is to be added. Profit and loss account balance last year, 1 for 2017. Profit and loss account balance of the previous year, that is how much? 500. So you write, current year profit after tax is 1,590. Profit and loss account, one for 2017. $500. Total is 2090. Then appropriations. 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 Here it is given. How the appropriation is to be made. Transfer to general reserve. Transfer to general reserve. $500. Appropriations. A part of the profit is transferred. That is transferred to general reserve. Then interim dividend paid. Interim dividend paid 20. Proposed final dividend. Interim dividend paid. Then proposed final dividend. Proposed final dividend. It is given Proposed final dividend is 10%. It is given is 10%. 10% of what? That point you should remember. Dividend is always paid upon paid up capital. Dividend is always paid on paid up capital. But paid up capital is given 500. It is not of profit. Profit in the 3% nalla. Dividend in the it is always paid on paid up capital. So 500 at 10%. How much it comes? 50. Proposed final dividend 50. Then there is dividend distribution tax given. How much is dividend distribution tax? $20. Dividend distribution tax. That is, tax on dividend is paid by the company. That is dividend distribution tax. Distribution tax. $20. Now the balance is to be carried forward to balance sheet. Profit carried forward to balance sheet. Profit carried forward to balance sheet. Forward to balance sheet. How much it comes? Profit carried forward to balance sheet comes how much? The difference. Difference comes how much? 500 plus 20 plus 590 you have to minus then 1500. You total 2090. This is how to prepare a P&L account. Usually revenue account is important from the examination point of view. Even then I have given an idea. So the points you have to remember when you prepare the whatever be the balance in the revenue account, that will be transferred to policyholders account. From that, with that, any income from investments, interest, dividend and rent, profit on sale bar redemption of investment, loss on sale bar redemption of investment and other incomes. These are to be adjusted, then you will get total. Then expenses other than directly related to insurance business, we have seen here general administration expenses, then loss on revaluation of general investments, etc. that you are. Then others. If there is any other expenditure, you have to write. Then you will find get the profit. Then provision for tax, profit after tax. You add with that current last year profit. Then you have to make the appropriations. Appropriations to general reserve. Then comes the proposed final dividend, interim dividend paid, proposed final dividend, then dividend distribution tax. The balance will be carried forward to balance sheet. Now we have to see how to prepare the balance sheet of a life insurance company or life insurance corporation. It is just as in the case of, yes, you already studied how to prepare the balance sheet of a banking company. Now it is the vertical form of balance sheet we have to prepare. But in life insurance corporation, instead of assets and liabilities and assets, you are writing it as sources of funds and application of funds. Sources from which the funds are raised. Actually, they come as liability. And the application of funds means the purpose for which the fund is put to use or the purpose for which it is used. So, in the balance sheet of a company, under source of funds, the first item is shareholders fund. Shareholders fund. Source of fund, shareholders fund. Under shareholders fund comes share capital, that is schedule 5. Then comes reserves and surplus. Schedule 6. First of all, let us deal with the share capital. In share capital, you have to show the details: authorized capital, issued, subscribed, called up, less calls in arrears, just as in company accounts. Calls in arrears, then called up capital, then paid up capital. If there is any forfeited shares account, balance of forfeited shares that is to be added with the called up amount, then if any par value of the shares that has been bought back, that is to be deducted. Par value of the shares that has been bought back, that is to be deducted, and preliminary expenses, that is expenses including commission and brokerage and underwriting of shares, that is to be deducted. So I shall sum up what I have explained. Details of the capital are to be given, that is authorized, issued, subscribed, called up, less unpaid amount, that is paid up capital, that is paid up. With that, you have to add forfeited shares forfeited, that is amount that has been originally paid on shares. Then from that you have to deduct the face value of shares and also any preliminary expenses, par value of shares bought back. So called up capital, less calls unpaid, with that you have to add shares forfeited, from that you have to less par value of shares bought back, par value of shares bought back, then comes less preliminary expenses. This will give you the share capital. So the points you have to remember, you have to arrive at the paid up capital, that is called up minus calls unpaid. From that you have to deduct, with that you have to add shares forfeited, that is the amount that has already been paid on shares that has been forfeited. Then par value shares bought back and less preliminary expenses. The preliminary expenses include commission or brokerage on underwriting of shares. Then you will get the share capital. These are the items which appear in share capital. Next to come reserves and surplus. That is schedule 6. Reserves and surplus. Under reserves and surplus comes different types of reserve. For example, capital reserve, capital redemption reserve, CRR account balance, securities premium or share premium, revaluation reserve, then general reserve. From general reserve, if there is debit balance in the profit and loss account, that is to be deducted, and the amount utilized for buyback, that is to be deducted. Then catastrophe reserve, other reserves, balance of P&L account. So schedule 6, reserves and surplus, the items that come capital reserve, B. CRR, Capital Redemption Reserve. Redemption Reserve. Share premium. Then revaluation reserve. Revaluation assets, etc. Revaluation reserve or revaluation policies, etc. Then general reserve. General reserve. From general reserve, you have to deduct debit balance of P&L account minus debit balance of P&L account, and amount utilized for bought back. Amount utilized for buyback. Amount utilized for buyback. That is to be deducted from general reserve. Then comes catastrophe reserve. ദുരന്തങ്ങൾക്ക് വേണ്ടി ഉണ്ടാക്കുന്ന catastrophe reserve. Then comes any other reserve. Now, balance of profit in P&L account. Balance of profit in P&L account. Balance of P&L account. Balance of profit in P&L account. Yes. Under reserves and surplus come capital reserve. Any capital profit, then capital redemption reserve, securities premium or share premium, revaluation reserve. From general reserve, you have to remember that any debit balance in profit and loss account and amount utilized for buyback, that is to be deducted. Then comes catastrophe reserve, any other reserve, and balance of P&L account. Balance means not debit balance, but profit. Balance of P&L account, that is profit, balance of profit in P&L account. Now you will get the subtotal. You have to write the subtotal. That is, subtotal means you have to write the total of shareholders fund. Subtotal. That is shareholders fund. Shareholders fund is share capital. Then comes reserves and surplus. Now, next item is borrowings. Schedule 7. Schedule 7. Borrowings. Borrowings may be done on debenture or bond. Debenture or bond may be issued. Debenture bar bonds. Then comes from banks. Then financial institutions. Financial institutions. Others to be specified. You have to point out which are them. So under borrowings, it comes debenture, then borrowings on debenture or borrowings on bonds, then borrowings from banks, borrowings from other financial institutions, other kinds of borrowings. Yes. Now, subtotal, then total. Now you are getting the total of the sources. Total of the sources. Of total of the sources will be the sum total of Schedule 5, Schedule 6 and Schedule 7. What are the sources from which funds are raised? One is by issuing share, then reserves and surplus, then borrowings from others.